This wasn't a bad trading day. This wasn't normal volatility. In less than an hour, gold and silver erased trillions in value, silver dropped $15, and markets across the globe froze at the same time. When safe haven assets collapse this fast, it's not an accident. It's a signal, and the reset has already begun. I'm recording this on Wednesday afternoon, around 4 p.m., here in New York City. Let me know in the comments what time it is where you're watching from, whether you're tuning in live during market hours or catching this later on. I'm always curious how global this audience really is. And while you're down there, I'd also like to hear how this move impacted you personally. Were you holding silver during the flash crash? Did you take a hit, break even, or come out ahead? Real experiences matter more than headlines, and they help put these market moves into perspective. Before we continue, one quick note. The analytics show that a large portion of viewers watch these breakdowns consistently but haven't subscribed yet. If you're finding value in this kind of macro-level perspective, the kind that focuses on structure, risk, and what's happening beneath the surface, consider hitting the subscribe button. It genuinely supports the channel more than most people realize and helps ensure these deep dive updates keep coming. This move wasn't just rare, it was structurally abnormal. Markets are designed to absorb stress gradually, through waves of buying and selling that allow prices to adjust in steps. What happened here skipped all of that. Gold and silver didn't drift lower, they collapsed in a near vertical move, erasing hundreds of dollars in gold and double-digit losses in silver in a matter of minutes. Events like this are so extreme that they sit far outside what traditional risk models even account for. These are the kinds of price moves that aren't supposed to exist in orderly markets. When something like this happens, it immediately tells us the problem wasn't fear or headlines. Retail traders don't cause trillion-dollar moves in minutes. Long-term holders don't all panic at the same second. What you're witnessing instead is forced liquidation, positions being closed automatically, not by choice. When leverage builds too high, the market becomes fragile. All it takes is a small push, and suddenly margin thresholds are breached, collateral requirements spike, and positions are dumped at any price just to survive. That's not selling. That's liquidation. The speed of the decline matters more than the size. A $15 move in silver over weeks would barely raise eyebrows. A $15 move in under an hour changes everything. Speed reveals structure. It shows that liquidity vanished instantly, that bids were pulled, and that there simply weren't enough real buyers underneath the paper contracts being unloaded. Prices didn't fall because sellers overwhelmed buyers. Prices fell because buyers disappeared. And when buyers disappear in leverage markets, price doesn't search for equilibrium. It free falls. This also exposes a deeper issue. Markets today are not driven by fundamentals in the short term, but by mechanics. Algorithms, margin systems, collateral rules, and leverage ratios now control price behavior during stress. Once certain thresholds are crossed, selling becomes automatic and self-reinforcing. One liquidation triggers the next, which triggers the next, until the entire structure feeds on itself. That's why these moves feel surreal when you watch them live, because human decision-making is no longer in control. Historically, events of this magnitude only occur during moments of transition. They show up near major turning points, when old pricing models stop working and new ones haven't fully formed yet. That's why this wasn't just a bad day for metals. It was a glimpse into how fragile the system has become. When assets that are supposed to provide stability suddenly behave like high-risk instruments, it tells you the foundation underneath the market is shifting. This wasn't noise. It was the system revealing its limits. This wasn't a market reacting to information. It was a market reacting to internal pressure. True price moves driven by news usually unfold in stages. Traders digest information, positions adjust, volatility rises, and the market finds a new range. None of that happened here. Instead, prices dropped in near-perfect synchronization across assets, which is a telltale sign that the stress came from inside the system itself. When markets move like this, it's not about what happened. It's about what finally couldn't hold anymore. Modern financial markets are built on layers of leverage stacked on top of one another. Futures contracts, derivatives, rehypothecated collateral, and algorithmic strategies all rely on the assumption that liquidity will always be there when needed. That assumption holds until it doesn't. When volatility spikes suddenly, those layers start to destabilize. Risk models flip from normal to emergency mode, margin requirements jump, and automated systems begin reducing exposure all at once. The result isn't a gradual adjustment, but a chain reaction. Once that chain reaction starts, the market stops behaving like a market and starts behaving like a machine under overload. Positions are closed not because traders want to sell, but because they are forced to. Collateral that was considered sufficient minutes earlier suddenly isn't. Assets that were meant to hedge risk are sold alongside risk assets themselves. That's why gold, silver, and equities all fell together. Correlations went to 1, not because fundamentals aligned, but because everything became collateral. Liquidity is the first casualty in moments like this. Market makers pull back, bid sizes shrink, spreads widen, and in extreme cases, bids vanish entirely. When that happens, even small sell orders can cause massive price gaps. This is what it means when people say the market snapped. It didn't bend. There was no orderly repricing. There was simply nothing underneath the price to catch it. That's not volatility. That's structural failure. What makes this especially concerning is how fast it happened. Speed indicates fragility. A resilient system absorbs shocks over time. A fragile one collapses instantly. The fact that prices fell this hard this quickly suggests the system was already under immense strain long before the move began. The flash crash wasn't the cause. It was the symptom. The stress had been building quietly, hidden behind rising prices and calm headlines, until it finally had nowhere left to go. This is why these events matter so much. They expose the mechanics most people never see. They reveal that stability in modern markets is often an illusion, maintained by leverage and confidence rather than solid foundations. When confidence breaks, the machinery takes over, and human intent becomes irrelevant. What we saw wasn't panic. It was the system hitting its own limits, and once a system shows you where it breaks, it rarely goes back to behaving the same way again. One of the most alarming aspects of this entire event wasn't the crash itself, but where it didn't happen. While prices collapsed in one part of the world, they were doing the opposite elsewhere. That kind of divergence is not supposed to exist in a global market. In theory, metals trade as a single, unified asset class with minor regional differences. In reality, what we just witnessed was a fracture in global price discovery, and once that fracture appears, it's incredibly difficult to repair. Paper markets are designed around speed and leverage, not delivery. Contracts trade hands thousands of times without metal ever moving. As long as confidence remains high, this works. But when stress hits, those paper prices can detach from physical reality almost instantly. That's exactly what happened here. Selling pressure crushed futures prices, not because metal was suddenly abundant, but because paper positions had to be unwound at any cost. Meanwhile, in markets where physical supply actually matters, prices were being bid higher, not lower. Same asset, radically different signals. This is where the illusion starts to crack. If silver is collapsing in one market but soaring in another, the problem isn't the metal. It's the pricing mechanism. The gap between paper and physical tells you that one side is trading promises, and the other is trading scarcity. When those two worlds drift too far apart, arbitrage becomes irresistible. Metal moves from where it's undervalued to where it's most needed, draining inventories in the process. And once physical inventories start moving across borders, the imbalance accelerates. These price splits are early warning signs. They show up before major supply events, before official shortages, and before headlines admit anything is wrong. The paper market can print infinite contracts, but physical markets cannot create metal on demand. When real buyers step in and keep bidding higher despite falling paper prices, it tells you supply is tight and trust is fading. Over time, paper prices are forced to reconcile with reality, not the other way around. What makes this situation especially dangerous is scale. This isn't a small premium difference or a temporary glitch. The spread was extreme, sudden, and impossible to ignore. That suggests coordination issues, structural stress, or deliberate prioritization of supply. Regardless of the cause, the effect is the same. Confidence in a single global price erodes, and once market participants start questioning which price is real, volatility doesn't decrease, it explodes. Historically, sustained divergences like this don't resolve quietly. They resolve through one of two outcomes. Either paper prices surge to meet physical demand, or physical markets seize up entirely. Both outcomes are destabilizing. Either way, the message is clear. The system is struggling to reconcile paper abundance with physical limits. What we're seeing isn't just a price move, it's the beginning of a credibility test. And those tests tend to reshape markets permanently. While paper prices were collapsing on screens, the physical market was sending a completely different message. And it was doing so quietly, without headlines or panic. This is how real shortages begin. They don't start with empty shelves and public announcements. They start with delays, backlogs, and suppliers quietly stepping away from new commitments. When refiners and mints stop taking orders, it's not because demand disappeared. It's because supply can no longer keep up in a predictable way. Physical silver doesn't move at the speed of algorithms. It has to be mined, refined, transported, and fabricated. That entire chain depends on stable pricing and reliable delivery schedules. When volatility becomes extreme, those assumptions break down. Suppliers hesitate to lock in prices when the market is swinging violently because they risk delivering metal at a loss. The first response is not an official shutdown, it's silence. Orders are paused, allocations are reduced, delivery windows quietly stretch from weeks into months. At the same time, premiums begin to tell the real story. Premiums don't rise because of speculation. They rise when metal is hard to source. When wholesalers start charging dramatically more above spot, it means the spot price no longer reflects replacement cost. In other words, the price you see on a screen isn't enough to actually acquire metal in the real world. That gap between paper price and physical cost is where stress hides, and it tends to widen before anyone admits there's a problem. What makes this moment especially significant is that these supply issues are appearing across multiple regions at once. That suggests the problem isn't local logistics or temporary demand spikes. It points to a broader imbalance between available refined metal and global demand. Even if some regions appear oversupplied on paper, others are clearly competing for limited physical stock. Once that competition begins, inventories don't last long. Metal flows toward the highest bidder, leaving shortages behind. There's also a psychological shift happening. When buyers realize availability is uncertain, behavior changes fast. Orders are placed sooner, quantities increase, long-term contracts are preferred over spot purchases. This accelerates the tightening process. What might have been manageable under normal conditions becomes critical under stress, and because physical supply cannot respond instantly, prices adjust not smoothly, but abruptly. This is why physical market stress matters more than any chart pattern. Paper markets can reset overnight. Physical markets cannot. Once backlogs form and trust erodes, it takes time, often months or longer, to restore balance. Even if paper prices recover quickly, physical constraints tend to linger. That's how disconnects become entrenched. The real danger isn't that silver is temporarily hard to get. It's that the system is revealing how thin the margin of safety really is. When availability tightens at the same time, confidence weakens, markets don't stabilize, they fracture. What made this move especially violent wasn't just existing stress in the market, but how quickly that stress was amplified. Volatility doesn't always emerge naturally. Sometimes it's accelerated by structural changes that hit at exactly the wrong moment. When conditions are already fragile, even small adjustments can trigger disproportionate reactions. In leveraged markets, timing is everything. And when pressure is applied at the peak of positioning, the result can look less like a correction and more like an engineered collapse. Raising the cost of holding positions during periods of heightened leverage forces immediate decisions. Traders who were comfortably positioned hours earlier suddenly find themselves out of compliance. They don't get time to reassess fundamentals or wait for stability. They have to act. The fastest way to reduce risk is to sell. When many participants are pushed into the same decision at the same time, selling becomes reflexive and self-reinforcing. That's how orderly markets turn chaotic in minutes. This kind of volatility hits asymmetrically. Large players with deep capital reserves can weather sudden changes. Smaller participants and over-leveraged traders cannot. They are forced out at the worst possible moment, locking in losses and transferring risk upward. This dynamic isn't accidental. It's a recurring feature of leveraged systems. Sudden rule changes during stress don't remove volatility. They concentrate it. Weak hands are flushed, liquidity thins, and prices overshoot in both directions. Once this process begins, control is briefly restored, but at a cost. Prices collapse faster than fundamentals justify, confidence takes a hit, and participation drops. Market depth doesn't return immediately because trust has been damaged. Participants who were burned step back, leaving fewer buyers and sellers. That reduced depth sets the stage for future instability because the market becomes more sensitive to the next shock. What looks like stabilization on the surface often masks a weaker underlying structure. There's also a signaling effect. When volatility is handled this way, it sends a message to the market about who is protected and who is expendable. That changes behavior going forward. Traders reduce exposure, hedging becomes more aggressive, long-term positioning shortens. These shifts don't calm markets. They make them more brittle. Every future move carries more weight because fewer participants are willing to absorb risk. In the end, this wasn't just about price moving lower. It was about who survived the move. Volatility became a filter, separating those who could endure sudden pressure from those who couldn't. And while the immediate chaos may fade, the consequences linger. Markets remember events like this. They adjust, but they don't forget. Once volatility has been weaponized, it tends to reappear, sharper, faster, and more destructive the next time. What makes this moment different from ordinary market turmoil is the pattern. Resets do not begin with clarity, consensus, or clean narratives. They begin with confusion. Prices move in ways that feel wrong. Assets that are supposed to protect capital suddenly behave like liabilities. Correlations that held for decades break down in hours. This is exactly how systemic transitions announce themselves, not with announcements, but with contradictions. When markets stop behaving the way participants expect, it's a sign that the underlying rules are changing. In the early stages of a reset, instability shows up as violent repricing. Markets are forced to confront mismatches that have been building quietly for years. Too much leverage, too many promises, too little real backing. When those mismatches collide, prices don't adjust smoothly. They gap, overshoot, and reverse without warning. This is not the system failing all at once. It's the system shedding excess. Old assumptions are being stress tested, and many of them are not surviving contact with reality. One of the clearest signals of a reset is when traditional, safe assets lose their stabilizing role. Gold and silver are supposed to absorb fear, not amplify it. When they crash alongside risk assets, it means everything is being treated as collateral. That only happens when the priority shifts from growth to survival. In those moments, liquidity matters more than logic, and cash flow matters more than long-term value. This is not bearish or bullish, it's transitional. Another defining feature of resets is speed. They don't give participants time to adapt. The goalposts move before strategies can be adjusted. What worked yesterday stops working today, and what replaces it isn't obvious yet. That uncertainty forces markets to probe for new equilibrium levels through volatility. Prices swing violently because the system itself doesn't know where balance lies anymore. It's searching, and that search is destructive. Importantly, resets don't finish quickly. The initial shock is just the opening phase. After the first fracture, markets often experience sharp rebounds, false recoveries, and renewed breakdowns. These are not signs of resolution. They are symptoms of instability. Confidence erodes unevenly, returning in some areas while disappearing in others. That unevenness is what keeps volatility elevated long after the headlines move on. This is why today's event matters beyond a single trading session. It wasn't about predicting the next price tick. It was about witnessing the moment when stress became visible. Once a system reveals where it breaks, participants change how they behave. Risk tolerance drops, time horizons shorten, trust becomes conditional. Those behavioral shifts reshape markets just as much as policy or fundamentals. Resets are uncomfortable because they expose reality. They strip away the illusion of control and remind participants that stability is not guaranteed. It is managed until it can't be. What we are seeing now is the opening act of that process. Not collapse, but transition. And transitions are messy, volatile, and unforgiving to those who assume the old rules still apply. The real question isn't whether prices bounce tomorrow. It's whether this was just a correction, or the first visible fracture in a much bigger shift. Because markets like this don't calm down quietly. They escalate. Let me know what you think happens next. Stay sharp. Things are moving fast.